Josh, when we spoke last 6 months ago, we had discussed office to residential conversions, and you had mentioned that you've looked at many deals, but none were right. They didn't pencil out. Why was this one different?
A number of reasons. I mean, I think when we looked at office to residential, we had a high bar because it is a challenging business plan to execute, and only so many people that have executed it flawlessly, seamlessly over many years. I haven't found anyone that's done it for as many years as Nathan has. So, you know, in his 20, 25-year career, he's done many deals in office to residential conversions. And frankly, I don't think you've built ground up at all, right? It's been all office to residential. So I think Nathan had a blueprint for doing that. And obviously one of the major factors also was that office to residential conversions didn't have a tax abatement in New York up until last year. And that was a great opportunity to create a deal that has a cost structure that allowed for the costs associated with the improvements.
Nathan, from a developer's perspective, I'm sure you're looking at a lot of deals. What drew you to this one?
We approached David Werner, who bought these assets a while back. We approached them about converting these buildings that were going to be vacant soon. And it took us a couple of years, or rather probably the sort of a distress in the commercial market that finally brought us together. We were fortunate to come into this project at a very attractive basis. And this is the largest we have done to date. And we are very excited about it.
In terms of the Class B and C office market, obviously rents have absolutely nosedived, and then you look at one of Vanderbilt, rents are doing just fine. Do you think there's a future for Class B and Class C office buildings?
Of course, there is a future. Look, you know, the office market is not going away. People are returning to offices. What has happened in the last 10, 15 years is owners have forgotten about longevity of buildings. The office market was so hot that no one thought that a 60 or 70-year-old building eventually will need a facelift, a total facelift, or would not be able to compete with other buildings in the area. And I guess the perfect storm, COVID, vacancy, distress, high interest rates, it brought that problem to the surface, which would have ultimately have come up anyway. It just happened a little bit sooner. And so there's a certain portion of buildings that simply will not come back. It'll be too expensive to refurbish them, to make them viable again as office. And those are buildings that probably cannot be knocked down. It's too expensive to knock them down. And the only path for those are repurposing as resi. The tenant amenity evolution.
It's a function, I would say, of the scale of the building.
Absolutely.
But one of the interesting things about this is you got 1,600 units, and you have the scale to put in 100,000 square feet of amenities. You know, that's not every building have those features.
Our sort of fascination and focus on scale has to do with in fact, exactly what Josh just said, the ability to actually deliver. We are creating almost like a little mini, village where there will be probably, if you're talking about 1,600 apartments, you're probably talking about close to 3,000 residents in a single building. That's probably the equivalent of 5 or 6 Chelsea blocks in one spot. And clearly it gives us the ability, this scale gives us the ability to offer people amenities that on one hand people demand, and as prices go up they expect to see. And this scale of project allows us to actually give us the ability to afford to offer that.
Josh mentioned the 467M abatement. I want to get a little more perspective in terms of when you were looking at the deal and underwriting the deal. Why was that so essential?
Actually, in this particular deal, 467M was not essential. The deal would have worked very nicely. This was sort of icing on the cake for us. There are actually many other deals that 467M makes them a lot more viable than they would have been otherwise. And the combination of 467M and the city of Yes, you sort of hit it out of the park.
That was the biggest zoning change since the 1960s, City of Yes. So it's sort of like, I think like what was done here in New York is really the blueprint for other cities, because so many cities are hitting the challenges of central business district, waste, crime. What was done here in New York City is the blueprint for probably the rest of the US in terms of spurring development, spurring housing. And again, Nathan's, if anything, the challenge is not finding the buildings or the cities, it's finding more of Nathan here. You know, how do we replicate or clone him?
But
you know?
but I'll tell you, that special sauce supposedly that at least I think we bring to deals, City of ES and 467M eliminated the need for that special sauce, frankly.
Right.
I think that today, someone doing a conversion for the first time, the numbers have become so compelling that, and the regulatory environment, and frankly, 467M being as accretive as it is, it's really an amazing combination.
Do you think this is relevant in other cities, or do you think New York's special?
Well, I always think New York is special.
Cities that are short on housing, you know, and have zoning constraints. I mean, this is a way to take existing stock.
As I said, they hit the bullseye.
In terms of hard costs and soft costs, maybe you can step us through what you're looking at in terms of this project.
We do everything on a cost plus basis, and the existing square footage we're converting probably for a little bit under $300 a foot in hard costs, and adding square footage to this to 235 and to 219, probably somewhere in the $450 a foot range. One of the reasons that I sort of got into conversions in the first place is we are probably 1/3 cheaper in terms of costs and in terms of time to deliver a project. A project of this size ground up would take a developer here in New York 7 to 9 years. We will start renting here next November.
Nice. In terms of costs from a lender's perspective, obviously the tariffs on aluminum, steel are still in place, 25% tariffs. How has that changed your underwriting of deals, or has it?
Well, we're just stress testing sort of cost and budget more than we would have initially. So we're really looking at that and, you know, thinking about it in the context of, do we need some more contingency than usual? Timeline, you know, is also important. Is this going to take a little bit longer because of some of the items?
From an architectural vantage point, in terms of ceiling heights, obviously floor plates are a big deal, light and air. Maybe you can step us through the plans for the building.
We already completed opening the bottom 10 floors to create the fourth side of light and air for this particular building, which is the deeper of the two buildings. We are going to take advantage, obviously, which we always do, of the existing ceiling heights. Finished ceiling heights in 235 will be at a minimum 10 foot finished ceiling height, whereas at 219, the neighboring building, ceiling heights there in the existing building will probably be somewhere in the 14 to 15 foot range, which is almost impossible to build today. You can't afford to build that type of ceiling height today in anything ground up.
Josh, maybe you can speak to the location. Some office to residential conversions have issues because you're trying to create residential in an office district, which seems different here. Maybe you can speak to the location of this project.
Yeah, that was a major differentiator for me, at least, because I believe that this was not a commodity location. And I know Nathan's done a lot of jobs downtown, but there is a lot of competition in terms of other conversions. So this had the benefit of being so close to Midtown, with so much new things going on in Midtown. JP Morgan's new headquarters, Citadel committing to a major development, you know, just in general, the absorption of the Plaza District and what's going on there. Also proximity to Grand Central, First Avenue with a lot of hospitals, the UN. So for me, when I looked at 1,602 units, that was not a daunting number, knowing that's 1% to 2% vacancy. And recently they came out with certain record rents in Manhattan. That continues right now. And a lot of it is the lack of product. And more importantly, in this job, this is a 75-25. So 75% market and 25% affordable. And so you're really creating a need for both market rate and affordable units right now, which is a huge plus.
What do you make of the slow commercial real estate recovery?
It's just purely capital markets driven because rates have stayed higher for longer. The supply and demand fundamentals are in place for the most part. There's less supply and more demand in terms of rentals and housing, and obviously office is its own asset class. But I think it really comes down to when you double rates, short-term rates over, up 500 basis points and up fixed rates double, I mean, it is what it is. You can't support the same kind of debt level. Obviously cap rates going from what was a 3 cap in multifamily to a 5 to 6 cap in multifamily, it's a difference of value.
Makes a big difference in the market.
Yeah.
In terms of other office to residential conversions you're looking at, I'm sure your phone's constantly ringing. You're the office to resi king, and are you looking at a lot of projects? How many is too much for you? Or?
Our pipeline is very substantial already. We are looking to acquire more product for future conversion. But one good thing about conversions, they go very quickly, and that frees up more capacity for us. I'm looking at this sort of continued distress in the commercial market as a great opportunity to acquire more bricks, which is what we're doing.
Mm-hmm. It's interesting in terms of fundraising. If you look at the breakdown from public pensions, one of the sectors or the categories that has not been impacted as significantly and has kind of continued to maintain its share is debt funds. What do you attribute that to?
I think it's the fact that just given where the markets are, debt is sort of yielding equity-like returns without taking the equity risk of the unknown today. So I think what you're seeing is credit opportunities in first mortgage lending that's taking the share that banks once took. So part of it is the banking crisis of 23. We're not out of the woods on that yet right now. Mm-hmm. So I think there's this need for private credit. If I went back to like 2009 when I was fundraising, private credit wasn't really an asset class. It was me convincing pension funds, endowments, foundations, sovereign wealth funds that this was an asset class, this wasn't a trade. And I think there's a belief that this is an asset class, it's here to stay. So I think that there's more and more of an understanding by institutions and by the borrower community knowing why there's a need for it.
Nathan, obviously this was a competitive deal. Why did you decide to choose to work with Madison?
Josh is one of the reasons. We felt very comfortable with him. Mm-hmm. And frankly, the entire process, it was a pleasure to deal with. And it's not always the case with bankers. Mm-hmm. They were never asking silly questions. Dealing with someone that was as knowledgeable about construction and actually conversions, we felt a terrific connection. We felt very confident that he would, everything he said he delivered. That's somewhat rare with bankers. It was a very smooth and actually pleasant experience. And hopefully it's one of many more to come.
So I think one of the things that we see with, particularly in construction and development, there's a lot of sources of capital out there, right? But one of the challenges is, particularly a deal like this, that has a lot of moving pieces and it's very customized, 2 buildings being built, one conversion in ground up, so to speak, above the building. Having one counterparty that's dealing and servicing and sort of that's where we see that we can add value, because a lot of times you're seeing a capital stack with 4 parties. Some of the deals that may not go perfect in terms of like timing and execution and where rates are, usually getting a modification from 4 different parties is impossible. So a bilateral conversation, us and a borrower, is always sort of worth a premium. In this case, I don't think it was a premium, it was a market kind of deal. Mm-hmm. But at the same time, it's worth sort of that conversation. That's where we've really excelled, these kind of customized kind of financing.
What's the plan for the retail, by the way?
We have about 30,000 feet of retail. It's a little, until we sort of finish our facades, mm-hmm. We're not marketing it just yet. We are speaking with brokers, but this is a building that probably can support its own, its own coffee shops, cleaners, and a whole myriad of other retailers.
I mean, if you think about it, you used to have thousands of employees that went in and out of these buildings every day, right? And now you're basically, you lost that, and obviously it's Midtown East, and you have a lot of density here, but clearly having a few thousand people in the building is going to be great. And again, if you take that to some of the downtowns throughout the US that lost that that group of people coming in and out of their buildings and tax revenue for cities. That's where this need is. You know, the density you're recreating in tax space for the cities, again, that's the key piece of these deals.
Yeah, we just acquired another building on this block, at the end of the block on 3rd Avenue. Between these, let's say 3 buildings, we're talking about 2,200 units on a single block. That in itself is already, I think, that makes a neighborhood.
It's amazing.
Yeah.
Thank you so much for joining us, and it was an absolute pleasure. Looking forward to following this project as it comes into fruition. It sounds very exciting here in the former Pfizer headquarters to turn it into residential, and wishing you much success with the project.
Thank you very
you.
much.